Hey guys, today we're talking about RRSP qualified investments. I've seen so many people throughout my career put the wrong type of investments in an RRSP. They end up paying the fee, they end up having to pull the money out. There's consequences, there's taxes on that. CRA doesn't like it. So today we're going to look at what you can and can't put in there. If this is something that's top of mind for you, you've kind of been confused, you're frustrated, maybe you've had a letter from CRA and you don't know what to do, folks, we do this all the time for people. This is an area of expertise for us, RRSP qualified investments. Please go to speaktorob.com, fill out the form. We will have a call with you, no obligation, free call, figure it out, put your mind at ease. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisor Group here at Canaccord Genuity Wealth Management. Brings me great joy today to talk about RRSP eligible investments. So please take a moment before I get into the video to subscribe and also feel free to share your comments with us with respect to the video. So the RRSP eligible investments, kind of in a similar way than the TFSA investments, most people don't know that you can put a whole bunch of different stuff in there. So you can actually put, term deposits and GICs and you can put kind of anything that's done kind of through a branch level, but you can also put obviously stocks, you can put bonds, you can put preferred shares, you can have debentures in there, any kind of security that trades on an exchange. You can also do derivatives. So you can do a derivative is effectively a call or a put. It's an option, if you will, to buy or sell a stock at a future date at a future price. Those can be kind of very, very volatile. They're swing and miss, but sometimes people who own them, if you are owning them, sometimes it would make sense for you to own that in an RRSP. You could also do real estate investment trusts. You can do exchange traded funds. You can do mutual funds and seg funds, bonds. So you can do provincial bonds, corporate bonds, even government bonds, Canadian government bonds. You can do Canada savings bonds. You can actually put your own mortgage or mortgage. You could structure a mortgage product to put in your own RRSP. They also have private mortgage funds, like private debt funds. You could also do alternative asset classes such as real estate, private REITs. You could also put those in an RRSP. And basically the way it works is CRA does not maintain a list, as a matter of fact, of specific investments that are qualified or are not qualified, and nor do they make determinations. So the way it works is there's a list, there's rules, and if they feel you're breaking the rules, then they're going to reach out to you and let you know. So this is very important. If you're not sure about how to do this, go to speaktorob.com and we can book a call to chat about this. But basically, the big ones that you should be avoiding, that you should be concerned about, and at a minimum, you should talk to us about, or your tax expert, is private corporations. So if you own shares of a private corporation that doesn't trade on the exchange, or it's not kind of publicly traded, or if you own shares maybe options or derivatives of a publicly traded company. So maybe you were given options and the right to buy your own company stock at a future date, and maybe the shares now are worth dramatically more than they were when you were starting out in the company, and your thought is, oh, I have warrants to buy shares of my company at 15 cents, and I think those are worth $2 now. I'm going to put those in my RRSP. I'm going to get all the growth tax-free in my RRSP. Pump the brakes. Consider that for a sec. Talk to your experts. Talk to us about it, because CRA won't like that. And when they catch, they do fine. They reverse. They make you reverse it, and you end up being way worse off than had you just kind of owned it personally. So publicly owned corporations and the options on publicly owned corporations are the two big ones to consider avoiding or consider avoiding. The other thing I want to say real quick with respect to RRSP contributions is when you are making the contribution and when you're investing in there, I've seen this so many times. What advisors typically do, they will put the same investments, the same cookie cutter portfolios in your TFSA, in your RRSP, in your non-registered account, in your LIRA, in your corporate account. All of the investments are the same throughout across the board. And to me, that makes no sense, and that is not taking advantage of the fact that there are different tax rates, different tax implications for the different accounts. If you have that RRSP account, that is a prime opportunity. You're deferring the tax, and you're getting tax-free growth in there. So if you have a private MIC in your portfolio that's yielding 8%, that's classified as income, or if you have a PPN or a note that's going to be classified as income, that would be a perfect spot in the RRSP, because you get the tax-free growth, it gets converted, doesn't get treated as income, whereby you could have stuff like dividend-paying stocks and private REITs and publicly traded REITs in your non-registered account, whereby the tax implications are much favorable to you. Just something to consider when you are making that RSP contribution and you're considering whether or not your RSP investments are qualified. Think of that as well. Thanks for tuning in, guys. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group. Please subscribe, and we'd love to hear your comments. Send me your 2 cents, guys. Thanks. Have a great day.